Okay, year 11. So we're going to look at some financial planning and the sources. So the money you need to plan for and where you're going to get it. Okay, so the key concept. Obviously, all small business owners must determine how the business will be financed through the life of the business. So where you're going to get the money, what do you need the money for, and how much exactly do you need. This is the most crucial stage because it involves the finances required to commence and operate the business. So obviously when you're starting at scratch or you're buying a business, you're going to need some money to start that off. So this is where you decide, then determine how much you're going to need and where you're going to get it from.
Here at CommBank, we want your business to be successful, to be something you're proud of. No one wants any small business to fail, but sometimes they do. And often it's thanks to insufficient planning and funding. This is why creating a viable and comprehensive financial plan is essential for you and your business. Here are 5 easy steps to get you started with your financial plan. Tip 1. Calculate your business setup costs. These include accounting fees, registrations and licenses, equipment and fit out, and initial working capital. It's important you compare these overall costs so you can work out how much money you'll need to borrow to start your business. Tip 2. Forecast your sales and expenses. To do this, compare potential sales revenue to costs of goods sold and fixed costs of doing business. Also, calculate likely margins and put your pricing model to the test. Forecast for the next 12 months to give you the confidence that your finances will be working in your favour. Tip 3. Forecast your cash flow, as this is a vital component of any financial plan. New businesses often need cash to build the capacity necessary to service customers, and customers could be slow to pay. This could result in a cash flow gap and leave you vulnerable if you're not prepared. Tip 4. Forecast your balance sheets. This should be a snapshot of what your business will look like after 12 months. Base this on the purchases anticipated in your setup costs and the results of your profit and loss forecast. Tip 5. Calculate your break-even point. This is simply the point at which your revenue exactly covers your expenses. So it's important you work out how many sales you need to make to break even. And there you have it, a business financial plan. Get started on yours today.
Okay, so the 2 crucial questions that any business owner will ask themselves before they start in the business is, how much money will I need to commence operation? And when they find out how much money they need, where are they going to get it? So I've actually attached a financial planning Excel template to the wiki page, which is used by Commonwealth Bank, which will help you answer these questions of how much money you need. Alright, boys and girls, so when you're starting your financial plan, the first step you need to do is look at your establishment costs. So these are the costs involved in setting up the business, such as legal fees. You might have to get the service of a lawyer to get yourself legally registered as a company. Looking at furniture, you don't want to be sitting on the floor in your new office. You might want a desk and a chair to go with it. And then you might want a computer to do some business on. You might need some software to run some business off that computer. Motor vehicles, get from A to B, you might even need a delivery company. It's all going to be part of your establishment costs. Fixtures and fittings. You don't want the sun blinding through the window onto your computer, you might have to get some blinds. You want a nice carpet in the office? Well, you got to pay for it. Phone and electricity connection. Obviously, even the caves in Afghanistan had phone and electricity connections when the Taliban are operating there. Most offices, obviously the same. It's going to cost you. Stock, obviously your raw materials that you might be selling on. You might make your profit on in the future, but at the time when you're establishing, it's just going to be an expense. And obviously the rent on the premises that you're working out of. Okay, so continuing on with your financial plan, the second step is to look at the operating costs. So these costs involve in the ordinary day-to-day running of the business. So items such as wages paid to employees or even to yourself, advertising costs, the insurance on the premises or any motor vehicles, interest you pay on any loans or any debt you have, your telephone and electricity costs. So you might be sitting in your office on the phone 24 hours a day with all the electricity on. It's going to cost you when it comes to the bill time. Stationery you might need, pens, paper, printing, ink, anything like that, obviously part of the cost. Rent on the premises, any accountant fees you might use a service of accountant. Most people don't know how to do their own books, which would make sense. This is a major operating cost. Any motor vehicle running costs like petrol, tax, registration, insurance, all these different things. Again, will probably tie in with insurance up here as well. Okay, so you've planned for your establishment cost, you've planned for your operating costs. Now the next step is you're in a position to calculate how much finance will be needed to commence and operate the business for the first year. So this is important, obviously, that you understand how much money it's going to take to get your business off the ground. And why this is important is because research has actually found that the main reason small businesses fail is because of cash flow problems. So hopefully, by having a good, solid financial plan, you will avoid such traps. Okay, so now that we've figured out our costs, we have to look at the sources of finance available to us. So where can we actually get the money that we need to start our business? Just know for learning purposes, they're broken down into two categories. So internal sources, so obviously we get the money ourselves from maybe our personal finance, or we look outside, so external sources. So we might borrow from a bank, or hopefully maybe get a grant from a government or some other institution. Okay, so the first source we'll look at is internal, and it's equity. So this is the funds contributed by the owner or owners of a business to commence and build the business. Just note, if it is an incorporated business, so it's a company, then this word is known as the shareholders' equity. So what are the advantages of equity as a source of finance? Well, the first one is the obvious one, that it doesn't have to be repaid. Since it's your personal finance, you don't owe anyone any money, so it doesn't have to be repaid to anybody. It is cheaper. So if in comparison to taking out a loan from a bank, you have to pay back that loan plus any interest they pay you. So it's a cheaper source of finance. And the owner who contributes the equity to a business retains control over how that finance is used. So what this is basically saying is if you were to sell shares in a company to raise finance, well then you're giving away some of the control. So they can decide how the money is used and how the business is operated. Which is obviously you can avoid this if you've raised all the finance yourself. The disadvantages is the big one is the risk of the business failing and obviously you losing your personal finance. Okay, so look at the first type of external source. So debt. So this is defined as funds provided by sources outside the business, which must be paid back over time with interest. So obviously the sources from where you get this money would be from banks, other financial institutions, the government, and suppliers. Debt can be categorized by the length of time you intend to pay it back. So we'll look at short-term borrowing and long-term borrowing. So first we'll look up at short-term. So short-term is anything between, usually between 1 to 2 years. It is used to finance temporary shortages in cash flow or finance. The common financial products that you'll see in this category are bank overdrafts, bank bills, and bank loans. Okay, so these short-term financial products, a little bit more detail. The first one is a bank overdraft. There's no really specific time. It's usually just an agreed time between yourself, the business, and the bank, so not yourself. So the bank allows a business or an individual to overdraw their account to an agreed limit for a specified time. So I might have a limit of 10,000. So if I have 1,000 in my account and I need to have 5, I can take out an extra 5. I can take out my 1,000 plus the 5, and then I'll pay it back with interest over agreed time. Another one, bank bills. These are usually between 90 to 180 days, but again, they can vary. It's just the usual amount. The short-term securities issued by a business and bought by the bank. So it's a type of bill of exchange that are given for larger amounts, usually over 100,000 for a period of 98 days. So what this is basically saying is, as a business owner, I'm creating a security saying I need 100,000. I will pay it back in 120 days plus some interest, and the bank will agree to this and they'll buy that bill off me. So it's almost like an IOU if you want to think of it like that. Alright, and the last one we can look at is, well, just for this exercise, is trade credit. So 30 to 90 days, roughly about 30 to 90 days. So the suppliers provide products to a business with an agreement to charge for the goods or services later. So if you're trading, you need some tools or some wood, you can get these from the supplier and pay for them at a later date. So trade credit is attractive for small businesses because there's no interest charge and is easy to obtain. So you can obviously see the benefits of it there. So remember, like, categorize debt into the length of time you tend to pay it back. So I had short term between 1 to 2 years, and now we have long term borrowing. So this is usually 2 years plus. This type of borrowing can be secured or unsecured. So basically, the asset is you can take out a loan as using an asset as security, or maybe not. Interest rates are usually variable, so that they can change throughout the life of the loan or the debt. They're commonly used to finance larger expenses such as real estate, plant and equipment. So businesses, offices, houses, and cars, for example. The common financial products in this category are mortgages and leases, which we'll look at now in a bit more detail. Okay, so the long-term financial products explained. One you've all definitely have heard of. I'm sure you'll know someone who has one. A mortgage. So usually these are 15 plus years. So this is the loan that's secured by the property of the borrower or the business. So if you own a house or you own a piece of real estate, you will take out a loan using that as security. So if you do not repay your debt, well, then they can sell your house to get their money back. They're usually repaid through regular repayments, including interest, obviously, over an agreed period. Okay, so another long-term financial product, leasing. So this involves paying to rent equipment that is owned by another party. So the lessee uses the equipment, the leaser owns and leases the equipment. Commonly leased items are premises, machinery, and motor vehicles. This is the one that everyone kind of wants to get as their external source of finance, will be a grant. So this will be defined as a contribution or a subsidy. So it can be in cash or it can be in kind. Given by government or other organizations. The grantor is the one bestowing the grant, and the grantee is the recipient of the grant. They usually come with conditions, and they're not really expected to be paid back.